board retirement meeting of December 14th, and we will start the meeting with our roll call.
Ms. Covison?
Here.
I'm not hearing you.
You didn't hear me answer here?
Are you muted?
Is everybody muted? Can you unmute?
I think the other people heard me.
I heard.
All
Yeah, we
right.
could hear.
No, they don't hear
And I
you,
think
but
yours.
Doris is one of the.
So Doris is calling in. Doris, is that you? Okay, just bear with us, everybody. Sorry.
She's got to do the *6 thing to unmute.
Am I muted? Not muted.
We can hear you now.
No, I don't hear them.
Hello.
Yes. Mason, can you say something again?
Good morning. Can you hear me now?
Good morning. Now we can hear you. Thank you.
Okay, thank you. All right, we'll start with roll call again. Ms. Covison?
Here.
Mr. Hawkins?
Here.
Ms. Kavanis is absent by prior arrangement. Mr. Jurding?
Here.
Ms. Smith? Here. Mr. Cromer?
Here.
Mr. Shoemaker?
Here.
Ms. Harris? Here. Mr. Anderson?
Here.
Great, thank you.
Fantastic. Okay, we will now move forward. Now, I don't see Doris on here at all, but she's by phone, right? Or will she disappear?
Now she's saying she's in a Zoom meeting and, okay.
Allowed to talk. So it says it was 12:56. Okay, now I see her name anyway. Hi, Doris.
Doris, can you speak?
Good morning, Doris.
Yeah, Doris, we can't hear you or see you. No, that would be weird. So,
Well, we could do the allegiance and you can ignore us to the we know what they're doing.
sure, that sounds good.
Okay. And you want to leave us in the pledge of allegiance?
Ready? Begin.
I pledge allegiance to the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice. Thank you. Thank you all. We're still working on getting Doris in.
And just a reminder that we need you to speak up when you're making your comments so that they can hear. Sometimes the mic doesn't pick you up very well.
So the first order of business, and I am going to do this slowly, I'm looking at the list of participants, and is for public comments on anything not on the agenda, but I do not see any public.
There is no public in attendance.
Okay. How are we going to move the list? So,
I'm gonna try logging in. If I'm going to proceed with the resolution, there's no, we'll have to do it.
So our first item of business, item number 1 is a resolution 2022-29 authorizing this teleconference meeting to be held by Zoom and in person. So I will need, first of all, is there any public comment on that? And there's no public. So I will ask for a motion. Madam Chair, I move to have this meeting occur both online and in person. What this motion should say, that move to approve the resolution, approve the resolution on moving. Government code and assembly bill, this is the one.
Second.
It's your, I was on the wrong one. Okay, it has been moved and seconded to adopt resolution 2022-29. Any discussion? Yes, Mr. Burke.
Thank you. So I did want to mention that AB 361 that you're voting on now is scheduled by the legislature to end on February 28th of next year, and unless it's extended. And 361 has been allowing the trustees to appear remotely without meeting the other Brown Act requirements of having to put your address on the agenda and opening up your location to the public. So that is going to end at the after the February meeting. There are so those Brown Act requirements would go back into place starting at the March meeting. So if you wanted to appear remotely, you'd have to post your address and allow the public to come in. I did want to mention to you that the legislature passed Assembly Bill 2449, which amends the Brown Act to allow you to appear remotely. But it puts a lot of restrictions in. You have to have just cause, and I won't get into that now, but I'll send you an email and we can talk about it more at the January meeting because it's not really on the agenda for today, or if there are emergency circumstances. It also requires MCERA to continue to conduct its meetings in this kind of hybrid fashion where it allows public to comment remotely. So I just wanted to give you a heads up on that, and I'll send you an email that discusses the just cause and emergency circumstances and the requirements that MCERA must comply with to be able to allow you to appear remotely. For one example is you have to have a quorum at the office. So anyway, look for that email, and we'll talk more about it next month.
And it's just another example of how the pandemic has changed the way we do business. Trustee Judy.
And Jeff, because I'm on other boards, and we've discussed this at some of the other boards already. My understanding is that we also, under the old Brown Act provisions, have the option of allowing a publicly accessible location, let's say in different locations throughout the county, where one board member, 2 board members, doesn't really matter how many, and members of the public could zoom in from. So, for example, if we wanted to make a location in Fort Bragg, like say at a publicly accessible building, any member of the public could go there as well as 1 or 2 or 3 board members. So is that not an option?
That is an option. You're still meeting the 2 requirements that existed before COVID, which are 1, you're putting the address on and you're allowing the public to attend. So yes, that would meet the Brown Act requirements.
Jane. Any other comments? And welcome again, Doris. Glad you're with us. Okay, we need a roll call vote then to adopt this motion. Ms. Clemison,
Yes. Yes.
Mr. Hawkins,
Yes.
Mr. Dirty,
Yes.
Ms. Smith. Aye. Mr. Cromer,
Aye.
Mr. Shoemaker,
Aye.
Ms. Harris. Aye. Approved. Thank you all. Moving on to agenda item number 2, discussion and possible action regarding the election of board of retirement officers for 2022-23. And I'm going to ask Richard to speak. He and I have been talking about the chairmanship of this.
So, Kathy has served us very well. I've been vice chair, for a year, which has been 2 years. And the normal procedure is that you move through the chairs here, and I would be, likely the next chair. I'm going to decline to have that opportunity, and you might not want me anyway, but I'm going to decline that opportunity to be nominated for that. This past year, this coming year for myself and my family, it's been very challenging, and during the past year, I don't believe I've done my work up to stuff as vice chair, so I would not want to affect this board negatively by being a board chair. Not wanting to just, say, hey, I'm done, I can't do this. Actually, thought who would be the chair, a good chair for us, and took the liberty to talk to Quincy, and if you will have him, I will nominate him to be the chair for the next year, and he would gladly serve, and we still have a choice of vice chair and other offices.
Quincy, will you accept that nomination?
I will.
Wonderful. So Quincy Cromer has been nominated to serve as chair. So we would like a nomination for a vice chair and secretary. And then to do secretary, I think.
So I would help Quincy by trying to serve as the vice chair if nobody else is interested. And if I do that, I do not intend probably to move up the chair once again. It's just, I have experience in this organization that I think will be valuable in meetings. I just can't do both of them.
Madam Chair, will you entertain a motion? I would like to move to appoint Cromer as chair with the shoemaker as vice chair for the upcoming year. And you have a secretary. I'm a secretary. Excuse me. And I have our secretary continue with everything that he is. So well. Any other nominations out there? Do I have a second to the motion for adjournment?
Second.
Any further discussion? Any public comment? There's no public comment. Thank you. So we need a roll call vote on the motion that Quincy will be chair of NSERA for next year, Richard will be vice chair, and Vincent will be the secretary. Ms. Covison,
Yes.
Mr. Hawkins,
Yeah, aye.
Mr. Dirty,
Yes.
Ms. Smith. Aye. Mr. Cromer,
Aye.
Mr. Shoemaker,
Aye.
Ms. Harris. Aye. Approved. Thank you all for being here. So we will move on
on to the journal question. But if you can continue to share this time of meeting, or you can ask people to the back. I was playing the role in my shooting. Okay. We thought about that. Last year, Dan, we turned it over to me. I already made all my notes, so unless you want to point it out.
I'm very good where
Okay. Okay, next month, Quincy will be in charge, and you better be on time next month too. Quincy will start at 8:30 sharp. We move on to agenda item number 3, discussion and possible action regarding adoption of the 2023 board meeting calendar.
Madam Chair, I'd like to make a comment
That's
on
trustee
the
Harris.
calendar. This meeting was a full week of time to prepare for Christmas and various other holidays. At this point, it's moved to the middle of the month. That's very convenient for me as an educator, as an retired educator. And I would like us to consider moving that December 20th.
Yeah.
Meeting to the 13th of December. So we have a little more time of out of meeting, particularly for people who are going out of town. As in person having this meeting, so that would be my motion for consideration that we alter the calendar in that way.
Okay. I had another question, and maybe it needs to be this way, but in November, we had the meeting on schedule for the 1st, but this particular year, it doesn't conflict with the conference that it normally does, so I wondered if it couldn't be the 15th. Give us more time between October and November meetings. Doris, did you want to comment on that?
I believe the reason it was put on the November 1st was the week of Sackers. It could be difficult to prepare the packets and get the materials out, although I personally have no issue with the meeting being moved to the 15th. Certainly at this point, I don't know if I'll be attending the fall Sackers, but I don't have a problem with it being on the 15th if that's the preference of the board.
The only other thing that is normally happens in the first part of November is our actuarial evaluation presentation. And I believe the actuaries have always required us to have it that first week of November because they do have other clients. So we would have to confirm with Siegel if they could make that meeting change. Trustee Drew.
I would just prefer if we could meet on a day other than the first Wednesday of the month.
That's the only month we have it on the first.
Well, let us
So-
check with Siegel and we can bring something back next month to adjust the calendar if needed.
Does anybody have any issues with changing the December 20th to the 13th? In the office or other trustees?
No.
So if you bring another calendar back next month after you check with Siegel, we will see the December 13th instead of the 20th. Okay, thank you. We will not take a vote on the calendar today. We will look at it again next month. And thank you for doing that. It just seems like there's not a lot on the November calendar because we've just met. And then we notice, of course, today on December that we doubled up on some of the reports because we didn't have them in time for November. So this makes sense to me, but I'm okay either way, whatever Siegel needs to happen. Okay, thank you. So we move on then to the consent agenda. And all matters on the consent agenda will be approved in one action. We've got the minutes of November meetings. We have both the October and November 2022 retirement reports, and we have the October and November 2022 preliminary monthly financial reports. Are there any public comments? And are there any comments? And I just want to make one comment. I don't really want to pull it off the consent calendar unless you think I need to. But on the retirement reports, it looked like the numbers in the charts maybe didn't add properly because there were a bunch of zeros in there. And the ending numbers of October didn't agree to the beginning numbers of November. And I would have called and told you guys yesterday, but I read it like 10 o'clock last night. Anyway, so I think you need to check those retirement reports. Anybody have anything on the consent calendar? And if not, we're just going to adopt them by unanimous consent and ask staff to check into the retirement report numbers.
Would you like that brought back next meeting, or would you like us to send emails out to everyone?
If there's a problem with them, just email corrected ones out. It just looks kind of rich to me. I'm always looking at those numbers to see how many active and how many retired. If the actives go down and retired go up. Okay. I think we're getting to the things that we have some guests here to discuss with us. Agenda item number 5 is discussion of possible action regarding investment matters. So we will start with the monthly investment performance reports. Well, I won't tell you where to start. Greg, I guess you can take whatever order you would like on those things.
Well, thank you, Chair Smith. And it's great to see you all today. We have a few things to talk to you about. The first is the November performance report. And then we have an educational session on real estate. And that session is in response to some questions we received from you. We thought it'd be a great opportunity to remind you what you have today in terms of your real estate portfolio, but then also have a deeper dive in low-income housing, because that's a question we've heard from this group in the past. And I'm a jack of all trade, master of none, but I've got masters in certain areas to come along and help, and that's Aaron today. So Aaron's a member of our real estate group, and he's going to walk through the presentation, the educational presentation on real estate, and we're going to spend about 30 minutes on that part. Before we get into that, well, today in the markets, we have a Federal Reserve announcement that's going to drop in maybe about an hour, hour and a half or so, and everyone expects the Fed to increase interest rates 50 basis points. I think what's going to be more telling is the tone about future increases and the tone about the priority of wage inflation and goods inflation. So yesterday we saw a real huge rally in the market, and it's because we saw inflation numbers come down a little bit more than we thought. But if you look under the hood, we still have wage and services inflation. And I would guess that that's what Chairman Powell is going to focus on today, the need to continue to restrict the economic growth in order to keep that down. So that's what's going on immediately in the market today. We've had a really meaningful rally since the last Fed meeting. Stock markets are up 10% since the last Fed meeting. And you'll see in the monthly performance report, November's returns were quite robust. And we're coming off our lows, which is great. And since the end of November, we've continued to climb higher in both the bond and the stock market. So overall, stronger performance since we last talked to you about performance through the end of September. Are there any questions about the monthly report or anything going on in the capital markets before I ask Aaron to talk about real estate? Okay.
Good job.
Okay, well, great. So in the coming months, Callan is going to be conducting an asset liability study. We've already collected data from your actuary. They presented their report to you last month or the month before. And we've collected all of that input, and we're putting it in an asset liability study framework for you to look at over the next couple meetings. What One thing that's really interesting to me to look at is how much return we need to seek, what sort of risk do we need to take on to make this a viable investment program over the long run. And to take a close eye and look on how much money is coming in and how much money is going out, right? And we'll be able to model that with the idea that you're in a net negative cash flow position right now. So we want to model that over the long run, because that could have some implications about what type of assets we hold in terms of this liquidity need. Everything we see, the liquidity need is manageable, but you know what? We want to go through and document that. We want to go through and show it on a report and model it for you. So those are kind of a few of the key objectives on the asset liability study. Before we do the study, though, we always ask, are there other asset classes you want us to consider? And so recall over the last few meetings, we've talked about different asset categories. Most recently, it was private equity. And we said, okay, if you added anything, we would add private equity. We don't think you need to add private equity, but if you added anything, we would add that. What we can do on this study coming up is run asset mixes with and without private equity. So we'll show you both options. It doesn't mean you have to do one or the other, but we'll just show you both. But the idea, and one thing I wanted to make sure we're all on the same page is before we bring back the study is, so that is the one asset category we were going to put in, and we'll show it with and without. And it doesn't mean you have to adopt it, but we weren't going to add on any other asset classes unless we hear something differently from the board today. And I think we've kind of talked about this topic over the past few months too.
Robert, I see you have a comment, question?
Yeah, so I had asked Callan, let's get a little bit of clarification here, because we've kind of talked about multiple alternatives kind of here and there. And in the August meeting, Trustee Harris made a comment about wanting to look at private credit. So we had looked at private credit in past studies, but I just wanted to make sure that Callan was clear on what other asset classes are included. Do we want to include private credit to look at those sort of asset mixes as well as private equity?
Thank you, Robert. So any comments before we move forward? Okay, Greg, we're ready to move forward.
Okay, so we'll move forward with private equity with and without. At this time, we won't include private credit. We can always re-optimize a portfolio 6, 9, 12 months from now if you want us to take a look at private credit. But to me, the big few things to take a look at is that cash flow position and the total risk return profile. You only have about 21% in fixed income right now. So it's our point of view that you want to keep that really conservative as a flight to quality hedge. And that's why we haven't been as supportive of private credit for this investment program. Okay, so with that, maybe we'll move forward with the real estate discussion. And this is an educational presentation. This is not meant for us to be conveyed that we are advocating that you go out and you necessarily do something. This is just an FYI in response to some questions we received from you. So we're first going to talk a little bit about what does your real estate portfolio look like today? What do you have in it? Do you have any residential housing in it? And then what are some other plans and what's some other thing people are doing about affordable housing going forward? Okay, so that's the objective. And I'm going to hand it over to Aaron, and I'm hoping Hannah will be able to share the presentation on her screen.
Great. Thank you, Greg. Good morning, everyone. I'm happy to be here today. My name is Aaron Quach. I'm an Assistant Vice President in Callan's Real Assets Consulting Group. I've been with the firm for 5 years, and my primary responsibilities are both client coverage as well as research responsibilities. My primary research areas include open-end, core, and core plus real estate, residential strategies, including affordable housing, and ESG. So I'm excited to be here today and talk about real estate and affordable housing. I'm going to leave some time at the end for sort of a formal Q&A, but feel free to stop me and interrupt at any point if you have any questions that come to mind. If we could just move to slide 3 here to start the presentation. We've provided a quick snapshot of your current real estate portfolio. As you can see in the pie chart, the current real estate allocation is at 16%, which is above the long-term target allocation of 11%. The existing portfolio includes 2 open-end diversified core equity funds, also known as Odyssey funds. These are managed by Barings and DWS respectively. Both are diversified across property type and market, and they both primarily invest in stabilized core operating properties in major markets in the U.S. There is a performance snapshot, as you see in the table at the top here. But if you don't mind, I'm going to hold off on the performance story for just a few slides, and we'll get to that in just a bit. So going on to the next slide here at slide 4, this will just help put your existing portfolio into perspective, these next 2 slides, relative to the other ways that you can invest in real estate within an institutional portfolio. This is what we call the 4 quadrants of real estate, including real estate private equity, which you'll see in the top left box, and this is what you're invested in with Barings and DWS. We then have public real estate equity, also known as REIT. The bottom left, we have private real estate debt, which are private loans on commercial properties. And on the bottom right, we have public real estate debt, which is basically CMBS and CDOs. On the next slide, we've shown various types of strategies that a plan can pursue within a within a real estate private equity portfolio. This can include core real estate, where the majority of returns come from income and investments are primarily in stabilized real estate assets. As a reminder, again, this is the Barings and DWS funds. This is where they would fall into that core real estate bucket. As you move up the risk spectrum, there is potential for higher returns, primarily from appreciation returns as opposed to income. In exchange for this, you're taking on more risk, whether that's lease-up risk, redevelopment risk, and construction risk. Generally, on the lower end of the risk-return spectrum, for example, core funds, this will be an open-end fund structure, such as what you have with Barings and DWS. And as you move up the risk spectrum, value-add and opportunistic generally tends to be in closed-end fund structures, given the nature of the investments that they make. Moving on to slide 6, I'm going to now provide a quick summary of each of your funds, starting with Barings. This fund, as you can see by the gross asset value and net asset value, is on the smaller end of the peer group, which we identify as the Odyssey Index. So this is an index comprised of 26 different funds pursuing a similar strategy, all different sizes, and some have, minor strategy tilts. The smaller size Barings fund makes it, in some ways more nimble than some other funds, in the sense that when it comes to shifting property type allocation or moving out of specific markets, they can do so much more quickly with smaller deals than it would take for, let's say a $45 billion fund. However, that also means that a handful of challenged assets in this portfolio can have an outsized impact on performance. For example, as you can see here on the bar chart, the office allocation is actually very much in line with the Odyssey Index. However, the fund does have 4 central business district office assets, which are identified as commodity office. They're not necessarily the highest of the high-end office, and they're not necessarily differentiated either. These are located in San Francisco, New York City, Los Angeles, and DC. And several of these assets have some near-term lease rollover. So there's going to be some expected vacancy, assuming there's going to be some challenges leasing up those assets and backfilling that space if the tenants that are currently in place decide to vacate. So in the third quarter of 2022, Barings took a pretty significant write-down on these 4 assets. They communicated that they took a conservative approach with appraisers during this third quarter valuation, and they took more significant write-downs than the Odyssey as a whole took in the office sector with similarly challenged assets. Looking forward, I think Barings, as well as investors and consultants like us, are hoping for and expecting outperformance in the coming quarters, considering the fact that they took these write-downs in 3Q, presumably ahead of the write-downs that we'll see with the rest of the Odyssey index. As of a couple of days ago, they were not able to share forward-looking 4Q valuation numbers with us, as they're still going through that process. But as far as potential performance going forward, that is still to come, and that's something that we're going to be watching closely. Moving forward to DWS on the next slide, this is one of the larger funds in the Odyssey at $17 billion in NAV. This is about, I think they're the 5th largest fund in the Odyssey index. From a property type allocation perspective, they are relatively well positioned, as you can see on the bar chart here, with an overweight to the industrial sector and an underweight to the office sector. The industrial overweight is something that DWS established many years ago. It's something that they do quite well. We view them as relatively strong managers of industrial real estate in the U.S., and this has been a primary driver of their outperformance over recent years. The fund has seen an uptick in redemption requests. They have a redemption queue, as you can see here, of $872 million, in addition to 4Q requests that came in at about $700 million. So in total, this represents about 9% of NAV, which is in line with other large Odyssey funds. We're just in this situation where the rebalancing of plans that are coming into the denominator effect are putting in redemption requests, and this is sort of starting to add up. We're seeing this across the index, so we're not necessarily concerned about DWS's liquidity relative to some of their peers, but definitely something that we're watching. As far as fourth quarter valuations for DWS, they provided some general guidance on valuations. They said they're expecting 0 to -3% from an appreciation perspective, with office taking the largest write-down, followed by retail, industrial, and then residential. Going forward, their house view is still that industrial and residential, despite some of the valuation pressures that we're seeing as a result of higher interest rates, they're expecting both of those sectors to continue to be strong from a fundamentals perspective and to outperform over the medium term. Let's move forward to the next slide here. These next 3 slides are specific to sort of the general real estate market and not necessarily your portfolio. I'll try to be quick here, but essentially the snapshot here is on the third quarter performance, which is represented by the Odyssey index in the top right box, as well as the NCREIF property index at the bottom of that table, as well as the bar charts at the bottom. You can see that appreciation was relatively flat for industrial and apartments during the quarter, while write-downs were most significant for the office sector, followed by the retail sector. As I alluded to before, we're expecting similar performance in the fourth quarter, although we are expecting further depreciation, perhaps across all sectors, as a result of, again, higher interest rates, putting upward pressure on exit cap rates and discount rates, which go into the appraisal assumptions, and therefore puts downward pressure on value. On the next slide, we're going to show the transaction market and how that has been impacted by higher interest rates. As you can see on the far right there in the third quarter of 2022, we have seen a decrease in transaction volume. This is primarily due to higher interest rates increasing the cost of capital for buyers. Buyers need significant price reductions to generate the same unlevered IRRs as they were projecting prior to the higher interest rate environment. And in this current environment, sellers are not necessarily motivated or forced to sell their properties. There's not a lot of pressure from over leverage, which we saw during the global financial crisis. Not a lot of pressure with lenders at this point. So we're starting to see, a bid-ask spread, and the markets are in somewhat of a gridlock, at least until there's more confidence in the macroeconomic environment and the path of interest rates going forward. I would expect fourth quarter transaction volumes to be similarly low, similar to the third quarter transaction volume. Let's move forward to the next slide here. Now we're going to transition to the topic of affordable housing with a focus on the market opportunity, different ways to invest in the sector, and how your public plan peers have invested in the space to date. These next 3 slides focus on the current market dynamics of the affordable housing sector. There are some interesting charts in these slides, but I'm going to try to keep it at a high level here. The long and short of it is that we have a national housing shortage of about 3.8 million units. The estimates really vary anywhere from 3 to 7 million, depending on the source. More specifically, as you'll see on the next slide, we have a more acute affordable housing shortage. The affordable housing stock decreases over time for 2 primary reasons. Number one, housing units reach the end of their useful life and are eventually removed from the housing stock entirely. This could be demolition, this could be redevelopment into a different use. That's the first way that housing is removed, and affordable housing is removed from the housing stock. Number 2 is that units that were previously deed restricted affordable housing, meaning there are restrictions on income or rent regulations, those units reach the end of their affordability period and are then converted to market rate units. So institutional investors that are seeking to help address the affordable housing shortage can do so in 2 different ways. Number 1 is to add to the stock of affordable housing through the development of new units. And number 2 is to preserve existing affordable units by preventing them from being converted from affordable units to market rate units. Now let's go to the next slide here. This chart just helps to demonstrate the progression at which affordable units are reaching the expiration of their affordability period. So as you can see, over the next decade through 2030, there's going to be approximately 745,000 rental units that are going to expire. The affordability restrictions will expire, and there's a potential for these investments or for these units to be converted to market rate units, which will significantly decrease the supply of affordable units that we have in our pipeline. Let's move forward to the next slide. Here we're going to define exactly what I mean when I say affordable housing, because there's not necessarily a standardized definition across the industry that everybody can agree on. The closest thing that we have is the definition from the U.S. Department of Housing and Urban Development, which I'll refer to as HUD. HUD defines an affordable dwelling as one that a household that is earning the area median income can obtain for 30% or less of its income going to monthly housing expenses. When folks use the term affordable in this context, this can refer to both regulated and non-regulated affordable housing. You might hear some folks specify capital A affordable as a term which some industry participants use when explicitly referring to housing that is rent or income restricted. On the next slide, we're going to go through a couple of descriptions and definitions of the different types of affordable housing. I've listed the 5 main types of affordable housing on this table. I know there's quite a bit of text in the bullet points, so I'll try to do my best at explaining this and keeping it high level. I actually want to start at the bottom of this table with public housing, because this is not exactly an investable asset class for the private sector. Public housing represents a very small percentage of the current housing stock in the U.S. due to a long and complicated history with public housing that essentially, it's not well regarded, and it's not something that we're continuing to invest in as a country. State funding primarily comes from the federal and state governments for maintenance of the approximately 1.2 million units of public housing that are still inhabited. The other 4 categories here are investable opportunities. Starting with the low-income housing tax credit, this is referred to as LIHTC for short. This is the largest source of affordable housing units in the U.S. and therefore is generally what people refer to or think of first when it comes to affordable housing. Properties that are built using the LIHTC are generally required to be affordable for at least 30 years and up to 55 years depending on the state. These tax credits are delivered to the developer as well as their tax credit limited partners in the first 10 years, at which point those parties are typically bought out, which is generally where institutional investors can step in and acquire and maintain those properties. The voluntary regulation or municipal-driven strategy typically involves an agreement between a building owner and a state or municipal government, whereby property tax abatement or other subsidy is offered in exchange for implementing affordability restrictions. This definition is intentionally broad and vague because it really varies state by state and county by county. The Section 8 program is one that people may have heard of, although I think most people are familiar with the tenant-based voucher or housing choice voucher, which is where voucher holders can get subsidy directly from the Department of Housing and Urban Development. They are required to pay 30% of their income, whatever that is, to their housing expense, and HUD makes up the rest. This is the tenant-based voucher program, however, that most folks are familiar with. When it comes to institutional investors and the investable opportunity here, that's really with the project-based Section 8 program, whereby the voucher is assigned to specific units in a building rather than assigned to tenants. So if that tenant vacates the unit continues to be affordable with that Section 8 voucher for the next tenant that moves in. Similar to the tenant-based program, tenants are responsible for paying 30% of their income, and HUD pays the balance directly to the building owner. And finally, the fourth category on this page is naturally occurring affordable housing, which is we call NOAA for short. This is exactly what it sounds like. It's housing that a household earning the area median income can comfortably afford by paying no more than 30% of their monthly income towards rent. But it is not formally rent or income restricted as the three other categories of affordable housing that we just discussed are rent and income restricted. Other terms for this type of housing include workforce housing, attainable housing, missing middle housing, middle income housing, essential housing, and many others. There's a lot of different definitions. I prefer naturally occurring affordable housing, but generally speaking, if you hear any of those other terms, spoken about by managers or other industry folks, that's what they're referring to. It's housing that's affordable, but not income or rent restricted. Within your existing portfolio, Barings has some exposure to naturally occurring affordable housing within their portfolio. DWS does not have any workforce housing as they consider all of their apartment properties to be Class A or luxury apartments. Neither fund has any other forms of dedicated affordable housing, such as LIHTC, voluntary regulation, or Section 8 properties. Although both funds have a handful of properties with some designated affordable units. This is often because municipalities have inclusionary zoning requirements for new development. So if you build a new building that's an apartment property, the city or municipality might require you to restrict 15% of those units to 50% AMI, for example. And so some of those affordable units might exist, or they do exist in several of the market rate properties within your core fund. Moving on to the next slide, we wanted to pull together some information on what California public pension plans are doing in affordable housing to date. And here's what we found.
Excuse me, do we have a question, comment from Trustee Cromer?
Hi, Aaron. Regarding the low-income housing, I know that there was it's been different in recent history with the moratorium on evictions that was in place for an extended period of time during COVID. And I saw in the news this last week for the Bay Area, for San Francisco in particular, of a new occurrence where some renters are buying out, some landlords or owners are buying out renters to have them agree to leave their housing. In your opinion, is that some effort to avoid rent control, or is it in any way, shape, or form related to the low-income housing?
Yeah, that's a great question. Yeah, I saw the article that you're talking about. I think the payout was $450,000 to move out, which is pretty astonishing. Specific to that instance and what we're seeing in cities like San Francisco that do have rent control, the buyouts are specifically related to rent control. Essentially, these are tenants that have typically been in these units for extended periods of time, 20 plus years, and they've only, the building owners have only been able to increase rents by small percentage points year over year. And so these buyouts are really between the owners and the tenants to get them to move out so that the owner can mark these units back up to market rate and to avoid rent control or rent stabilization. To my understanding, those are not low-income housing tax credit units. Those are not regulated affordable units outside of the rent control legislation specific to municipalities. And so that strategy will not really work, or you won't have that risk in institutional managers, proposing these buyouts to tenants because of these programs being mandated at the federal or county level and not related to rent control or rent stabilization laws.
Trustee Harris, I just wanted to say when I was doing my homework last night and reading the various pension funds that are invested, the policies that we began quite well during my tenure. Many teachers, probably most in areas like San Francisco or in the Bay Area generally, and same thing with Los Angeles. We want good teachers in our schools if they can't afford on a teacher's salary to buy or even rent a house. So counselors obviously have continued policies that we made back then to try to have investments that would allow educators to educate and also for holding a roof over their heads. And I also noticed that CalPERS has continued its former lack of policy by not investing in affordable housing. Just a comment. Proud of CalPERS.
I thought PERS was
It is, but it says that they don't have a plan yet to make affordable housing part of their policy. Maybe they can't afford it.
Okay, Aaron, thank you. Are we heading?
I'm sorry.
We're on page 16.
Yeah, we're on slide 16. Yeah, that's a great point about teachers being able to afford housing in the communities in which they work. And so, we wanted to get into sort of what CalSTRS is doing, because I think their program is actually quite unique. Before we get into that, though, we put together, some research trying to identify all of the different plans, California plans that have been active in affordable housing. And here's what we found based on our knowledge of public plan portfolios, conversations with investment managers about their limited partners and investors in their funds, as well as third-party research using sites like PitchBook. The primary finding is that in the US, public pension plans in general have not been the first movers in affordable housing and impact investing more broadly. Other investors like high net worth individuals, family offices, endowments, foundations, banks, and insurance companies tend to be the more early adopters for various reasons. For banks, there's CRA credit. For some foundations and endowments, they're more can be more mission driven and things like that. Outside of the U.S., though, there has been more interest from public pension plans in Europe and Asia. Both of those regions tend to be further along in ESG and impact investing than the U.S. in general. There are only a handful of California plans that have invested in capital A affordable housing, so regulated rent and income restricted housing. However, there are many plans that are investing in naturally occurring affordable housing or workforce housing. I will say that investing in workforce housing or NOAA is typically not driven by an ESG strategy. It's usually for the supply-demand dynamics in workforce, which is generally, as we spoke about earlier, there's a shortage of housing, there's a shortage of housing that's affordable to people. And so there's an argument that, for some, investing in the sort of lower tier but not regulated housing has some attractive supply and demand dynamics that warrant investment even outside of the ESG or impact themes. So moving on to CalSTRS, they have invested in affordable housing in two different ways. First, they acquired a minority stake in real estate investment manager Fairfield Residential in 2005. They then became the majority owner of Fairfield in 2019. They launched a programmatic joint venture with Fairfield to invest in the acquisition, re-syndication, and development of affordable housing assets. Earlier this year, they also committed $150 million to Fairfield's open-end affordable housing fund as the seed investor. That's the first way and the primary way in which they invest in affordable housing is through their relationship with Fairfield. Number two, through the plan's Sustainable Investment and Stewardship Strategies Unit, also referred to as SISS, they made a $50 million anchor investment in the SOLA Black Impact Fund. This is a closed-end fund that targets affordable and workforce housing investments in Black and Brown communities in California. The SISS program is unique from other parts of the portfolio because they explicitly target ESG and impact investments. So the Fairfield investment was through their real estate portfolio, and the SOLA investment was through their SISS unit. Aside from CalSTRS, we've only identified one other fund that has committed to an affordable housing commingled fund on the equity side after speaking to various managers. AEW, which we spoke to, indicated that they have one California public plan invested in their open-end affordable housing fund, but they were not able to share the name of the plan, and Callan was unable to independently verify that information. So we're keeping that as an undisclosed plan. I wanted to add CalPERS on this list because, of course, they're the largest plan in California and in the United States. They have made various investments in non-subsidized workforce housing. However, they haven't made any affordable housing investments to our knowledge to date. And so potentially, that may be something that they're exploring, but is not something that they have done to date.
Aaron, I just want to make a side note. This is Kathy Smith. Trustee Harris, Jerry Harris, who asked that question, served on the board of CalSTRS for several years. How many years? 8 years. So she was there when they started making some of those affordable housing investments. So has a particular interest in what they're doing. Just wanted you to know we have a little bit of expertise on our board too. Thank you.
Great. Yeah, that's fantastic. Yeah. Yeah, they are continuing to, as far as our relationship with them and to my knowledge, they're continuing to explore those opportunities, and Fairfield is one of the sort of larger affordable housing managers. So that relationship with them, I think, gives CalSTRS a lot of visibility into what's going on in affordable housing. So I think all in all, that relationship has been accretive. I just have one more slide, and then I'm happy to open it up for Q&A. We don't have to go into detail here, but on slide 17, we put together this list of investable opportunities within the regulated affordable housing space in both open-end and closed-end funds. This list has grown significantly over the past 2 years or so. Particularly on the open-end side, we've seen a lot of new product launches for open-end affordable housing funds, given the sort of long-term nature, longer-term hold periods, and the ability to, basically not being forced to sell properties to buyers that may or may not preserve that affordability over the long term. We're starting to see a shift from managers that used to be closed-end fund managers and now shifting to the open-end side. One of the themes that we've seen over the past few years. So, I'll stop there with that. I'd like to, thank you for your time and attention, and happy to answer any other questions that you might have.
I just comment when I'm, looking at all the acronyms and all the information you've provided, some things jump out. The NOAA is an interesting one, the natural occurring. I mean, is that just another word for housing that's not very well kept, slumlords?
It can be. So I wouldn't define NOAA or workforce housing based on the quality of the properties or of the unit. It tends to be, I would define NOAA as based on the affordability of the rent, right? So if a household earning the area median income can afford to live in that property, paying no more than 30% of their income on rent, that is considered to be a NOAA property. Generally, because the more affordable properties tend to be older vintage, they may not have the nicest finishes, maybe not the nicest amenities. They may not be located in the best, submarkets. There can be a correlation between, the affordability of the unit or of the property and the quality of the property, but they're not necessarily always tied together. For example, there are strategies out there that are, targeting brand new development of workforce housing. They're going to try to build cheaper than other people, so it's still brand new units. But they are more affordable. So I would characterize NOAA more so by the affordability of the units rather than the quality.
And I think we probably all have people in our lives, family and friends, or people we know that are having trouble finding affordable housing that fits their income right now. So that's a really important topic for us. Comments, questions from any of the trustees?
Sure.
Yes, Richard.
So, like CalSTRS, obviously it's a big kind of regional investment. It looks like to me in the Fairfield Fund and the SOLA Fund. And then I also noted AEW, and it'd be interesting to understand, maybe you could furnish some more detailed information about how these particular groups function. On a very local level, I've worked for years with one of the largest rural affordable housing nonprofit in California. I think owns 26 units across the California area, not units, projects, right? Thousands of units. And you know, understanding how they go about putting their projects together, there always seems to be gaps and gap funding and so forth. And you know, are there particularly tools that could be gotten into to you know help these projects happen? You know, Dan and I in the past have talked about being real specific in investing our retirement funds for projects that retired Mendocino County employees would be first on the list on.
Is that affordable housing?
Well, that might be. They might all Vince might say they all qualify for affordable housing subsidies, but you know the big giant programs are of less interest. I want to invest in Boston. I just could invest in Calpella.
Yeah.
And if there's any way to get more information about how that could function for us, at least on a regional basis, like Northern California. And the background on the AEW and Fairfield, etc.
Yeah, we know both of those groups well, and we're happy to follow up with more information on specifically their strategy. I will say that, you know, your commentary on sort of the regional approach, the SOLA Black Impact Fund that CalSTRS has invested in, that's a California-focused fund. But the Fairfield Fund and all the other funds that I showed on the slide are diversified by state and by region. So none of those funds take a sort of specific approach to California or Northern California. There are certain managers that will do sort of a sleeve of their fund where, you know, they might give you access to specific deals, basically carve out of the fund saying, you know, we only want to invest in deals that are in California or are in Northern California. So that is, you know, potentially an option to pursue. You know, I certainly understand the desire to invest in your own community. I think that's great. I will say, just based on my experience with some other plans, there's an argument on both sides. I know some folks are perhaps sensitive to being landlords in their own communities where, you know, perhaps, you know, former county employees might be tenants in these buildings. And if there are any disputes between tenants and landlords, can be an element of headline risk. So something that I would want, you know, to sort of keep in mind. I think there is a camp in you know, there are two different camps with regard to that, but just something to think about as you consider, you know, as you continue to sort of ponder that idea.
Yes, Trustee Judy.
Yeah, so Aaron, the thought that I've had is, you know, we're one of 20 independent retirement systems and here in California, and we may have similar goals. And so, for example, to get away from that issue that you're talking about of having all of your eggs in one economy, if we as a group, and maybe there's a coalition of the willing of 5 or 10 of those retirement systems that get together and say, we want to partner with some developers in California who are going to develop apartments, for sale condos, detached houses, whatever, some combination of the above. in our collective counties or in California. And together we've diversified our portfolio in terms of geography and the local economies as a blend, but we are together bringing in some new investment into our communities, but we're sort of spreading the risk among the multiple counties. And then the other thought was, and one, I guess I'm kind of curious how the tax benefits of Prop 13 work for private investment. I know for an individual in California, it's pretty unique that the property taxes can only go up 2% a year. And you look at other states like Connecticut, other places, people are paying 2-3 times. I mean, it gets reassessed either every year, every 5 years, every 8 years. Even states that you hear of as being low tax states, North Carolina, other places, they're paying very high property taxes because their properties gets reassessed very frequently. And so it seems to me that there's some tax advantages in the space of real estate in California if someone's willing to hold on to the real estate in California for an extended period of time and not just keep churning the properties. So can you talk about how that kind of a strategy might be something that we could implement?
Yeah, definitely. I think on your first point about sort of getting the coalition together of other plans and partnering with developers, I think that's an interesting idea. We haven't had that conversation with other folks. I will say it seems like a more hands-on approach with staff to find the developers and find the projects, right? As opposed to what the current strategy is for this type of portfolio, which is to hire a manager that will then go and do that, all the development, all the sourcing of deals. So it's going to be a much more hands-on approach. I think, there may be a need to sort of, identify the right manager to sort of help with the implementation. So I think that's something to think about. On the property tax side, I will say, I see the hand up. Should I stop there and let you address the first part there? Or okay, I'll keep going. On the property tax side, I'm not sure if there is a benefit to, I can't say that I'm, familiar necessarily with the benefits of holding those properties and whether the reassessments, on an annual basis really changed between commercial and residential. I'd have to get back to you with the data specifically to answer that question. Although I will say that on the property tax side, there are definitely benefits to implementing affordability programs with property tax abatement. We talked about the municipal-driven or voluntary regulation strategy, whereby a building owner can restrict, let's say 50% of their units to 50% of AMI, and they'll get a permanent property tax abatement for 100 years. That's the program in Texas called the PFC program. Similar programs exist all over the country. You need to be able to work with specific groups that are experts in knowing the different regulations and the different laws and have relationships with the right, housing authorities to implement those strategies. But that's definitely something that folks are exploring, and we're seeing more and more of in real estate investing today.
And then the final benefit I wanted to just toss out there, if you had 5 or more counties, retirement systems working together, and assuming we have some kind of partnership with our cities within our county, because all city residents get county services and want to see the county do well. Cities and counties are constantly asked by developers to upzone their property, take it from a lower density to a higher density, and the developer is getting you could say is getting 95% of the benefit, and the public is getting a tiny fraction of it. If a city or the county knew that the developer of that property was receiving the benefits of that was going to go to the retirement systems that they're a part of, a coalition of retirement systems, at least they could think that, well, we're upzoning this property, but the beneficiary is our public employees, whether that CalPERS, CalSTRS, or the local retirement system. So I'm just saying, it's like, we're constantly in the position where we could be bestowing upon the developer significant windfalls in the returns by upzoning their property. Why not bestow that benefit to the investment portfolio?
Yeah, no, I think that's a really good point. Rather than the profits from the returns of the development going to developers' pockets or high net worth individuals that are friends and family of the developer, they could go to the employee retirement system. So I think that's an interesting proposition.
Yes, can you make that happen, Dan?
I think we know more than a few planners and more than a few public officials who vote on these.
Yeah, I'm sure.
I'm just saying, I think retirement systems, if they were to work with their county and cities, they could bring a lot of added value to the private developers that they're partnering with.
Mhm. Good point. Yes.
You know, the whole area that is east of 101, basically, and the Brush Street, what it is, I haven't been down that area lately. It's amazing how much development is occurring, and they seem to be all apartments. So we have an area to expand, and I believe that's still city property, isn't it?
The workforce housing that's to the north of Fresh Street is county land. I believe our CCC's got a few other projects that we for the city.
So city and county are separated by Brush Street?
It's a funny zigzag there, and if you look at the worst part of the street, you can tell that the line's right down the middle. And nobody wants to take care of it. Just like Beacon Way down here. Lived on over here, county line.
The current jurisdictional line is three, and so the sheriff's office does respond to all of these on the south and north side of the road.
Oh, both sides.
Yep.
Oh, okay.
So any further comments or questions for Aaron?
I would hope this isn't just dropped, that we might have a chance to explore it further.
Now, you did say, Greg, that this was just educational and you weren't making a proposal. Do you have any thoughts on this from Callan perspective?
Yeah, absolutely. This is in response to some questions we've received in the past. And so we wanted to bring you the information, the insight, the view of the world we have. You all have a different view of the world and have your own information too. And we can tell you about the product that exists out there. Like I could go tell you about the AEW product. The coalition of the willing doesn't, we work with you and some other counties, but that sort of thing would have to be, a lot of work from a number of different administrators, a number of different boards, and there's a lot of implementation behind it. Sounds like it's all very well intentioned, and there's certainly a big need for it all. But with that, we'd love to bring back any additional information you want on the topic, maybe just kind of give us, a focus on anything you would like us to bring back.
Just noticing the lag time between when we proposed all this at CalSTRS and 2019 before it was actually up and running. So a long period of education and exploration with an extremely large staff.
Mm-hmm.
Yeah. But I think there's tremendous opportunity out there. Yeah. Improve our communities and earn some money for the system.
Well,
I'm sorry, was that Dan? Go ahead, Dan.
Yeah, I do too. I think Richard and I both being people who've dabbled in the planning world for decades, we've seen that, there are so many regulations in California. They're navigable, but they take some skill and understanding and knowledge and patience. And because of all that, the state of California, and they'll report, there hasn't been enough housing built in California all but like 2 or 3 years in like the last 50. Since World War II, there's only been a handful of years where the state met its target based on population growth expectations. And so what you see is there's tremendous pent-up demand, which is in part why some people are moving to Texas and other states. That's part of it, but it's still the leakage out of California is not compensating for the pent-up demand. And so I think and again, with Prop 13 guaranteeing property taxes can't go up more than 2% a year for those who hold on to their property, knowing that that demand keeps going up. Rent prices I think in the long term are going to substantially exceed inflation in California. And so, owning apartments, I don't see how someone loses money. And, at least during the first 27 and a half years, they have depreciation on the building. And then maybe they do a 1031 transfer and upsize from a 4-plex to an 8-plex or something. And, but I mean, there's so many things in the tax code that do benefit people who have rental property in California. It's kind of hard to see how you could lose money on it and not be a good ballast with your stock portfolio.
So if, and this is maybe directed to Doris, so if this board were interested in looking further into this, Doris, do you have any idea if there's other counties that might be interested? I mean, from what I'm hearing from, Dan and Aaron is that, we have money to invest, and if we could invest it in something that helps our community, is there a way that we can make that happen? Or is it too complicated?
Unmute.
I can't hear you, Doris.
Yes, I should unmute. Sorry about that. It's really a little outside of my wheelhouse, but I'm sure there probably are some other counties that are facing, similar questions as far as how they can serve their county and benefit the retirement system by looking at affordable housing options. Fresno looked at something similar and they decided that it was too labor intensive for their own staff because they didn't have the expertise to deal directly with local real estate investments, but they did work with, I think it was RBC, to develop a portfolio of essentially mortgage-backed securities. And when those are sold on the open market, an agreement that those funds would be returned to local banks to do more housing lending. That didn't necessarily speak directly to affordable housing, but it was some way that they had an impact in their local county without having to be real estate experts or having to have, that detailed involvement as far as selection of properties and those types of questions. So there might be different ways we could look at addressing that. Whether or not there's other counties that would be interested in partnering in something like that, we could certainly put out a question to the Stackers group.
Well, I just know that this topic comes back. I mean, we had a previous trustee who moved away, who was Lee Parker, who was very interested in local investment, and the topic comes back over and over again. I just don't want it to drop. I'm just not sure how to move forward with finding out anything else. And I leave that up to you, Doris, just to bring us back some ideas. Or
would the board have any interest in looking at the type of product that Fresno used?
Sure.
Yes, I hear some yeses around the table. Just any more information.
Now, since we are currently overweight in our real estate allocation anyway, and I don't expect the real estate allocation to shift dramatically given the fact that we're a mature plan that is cash flow negative, is there really space for this in your asset allocation? Would you be wanting to pare down any of your other real estate exposures in order to fund something like this?
I don't know if we're in the position to do that, to make that. I'm just.
That does raise the issue of reallocation. It's typically done on schedule. If we're going to do it.
I think we've got a lot of learning to do before, we even look at this with any serious. But there's a big lag time.
Maybe it's something that I can speak with Callan with offline and see if that might be something that they could model as far as the asset allocation or the asset liability study that's coming up.
That sounds great. That sounds great, Doris. And I couldn't hear Richard's comment clearly. So, but so we could. One thing that'll be important to me is looking at the liquidity profile over the next several years for the plan, and also keeping in mind if it does become a shrinking pool of assets, we're currently at a $500 million. How much would you be willing to put at risk in something like this? And I think we should keep the kind of that in perspective, the amount of dollars you could actually put to work and make something feasible, operational, and manageable.
Magic word of risk, yes, risk, yes.
Yeah.
Of course, we have to look at that.
Yeah.
I don't think the board's in any position to make any decisions now. It's just the topic keeps coming up about trying to help our communities here with housing opportunities. And so it's just something that we don't want to disappear forever. We just want to keep educating ourselves. So I really appreciate the information, Aaron. That was a great presentation. Thank you for all the data. And anyway, it's good to have you and Hannah and Greg. Thank you again for being with us today. And I don't think the last item on that list was yours, right?
All right. Well, it's so good to see you all. Thank you, and happy holidays. I hope you all have the opportunity to take some time off and spend quality time with your family. So it's great to see you. I'll see you next year.
Happy holidays. Bye-bye.
Take care.
Bye. Was good. So we are moving on to item 5D, which is the State Street fee increase update. I don't know if this is Doris or Robert.
I'll let Robert start with that. He drafted the memo regarding the request.
Board of Retirement, you've got the memo in front of you. I'd be happy to answer any questions or concerns.
Can you tell me, Robert, what is included in custodial fees? I mean, the term's so general to me. What do they do for us?
Well, they have physical custody of all of our investments in a separate account. That's really what they're doing. In terms of the services that they provide us, they allow us to process trades. So they help with settlements when we need to move money from international to domestic, or move from real estate to fixed income, or whatever the change may be. They allow that processing to happen. They settle it. They keep records. So they act as a record keeper as well. Certainly, I've got access to some of the public information and statements from our managers, but they also have that access, so we can compare transactions and things like that. So they're a record keeper. They actually hold hold the securities. Those are the primary services that we use them for.
I appreciate that. I see Jeff and Doris both have their hands up. Jeff?
Robert, am I reading your memo correctly that we're in the middle of a contract term, and is there any obligation at this point to agree to a fee increase?
That is correct. We are in the middle of a contract term. The current term runs from November 30th, 2020 through November 30th, 2023. So we certainly are not, there's no obligation to pay the increase or to agree to it. However, it's my view that given the 3-year contract extension that we recently did in December 2020, that contract extension decreased a number of fees. There was minor changes up and down, but there was a $300 fee that we've been paying since 2015, since the inception of that contract. That was dropped in the contract extension. And so this fee increase, as I mentioned, it's a bottom line fee increase of 5%. And based on where the portfolio is at today, those fees are going to be likely somewhere between $250 extra a month to maybe $300 a month. Now, of course, if the stock market rallies, that number is going to go up. We hope that we hope that the stock market will return to its former glory. And so certainly the fees will increase in the future as our assets under management increase. But I guess the point being that this contract extension that we are in right now had a decrease in account maintenance fees that was actually more than the expected increase that State Street is proposing today. And that fee would be in effect from January through the end of our contract term, which is November 30th, 2023. So next November. At that time in October, we'll have a chance to renegotiate with them. We'll come to the board. We've been with them for 8 years. The board can give direction on whether or not we go to RFP or if we do another extension. A 1 or 2 year extension is not uncommon.
Doris, you have something to add?
I believe Robert covered it. I was just going to make sure that the board was aware that we did have, when we entered into the 3-year contract extension, a reduction in fee of the $300 a month account fee that they had been charging that they did away with. This essentially offsets that and puts us back into what we were paying prior to the fee reduction, except that this is a 5% across the board rather than a specific account maintenance fee. The contract is set to expire in November of 2023, and they reached out to all their clients. It's not just us to ask for an increase in fee of the 5%. So we're looking at, is it a benefit enough to agree to that for this 1-year term remaining on the contract? But it certainly is the board's decision on that. We will be up for renewal with them in November of 23.
So do you need a board motion to accept this fee increase?
This would require a board motion.
Madam Chair, I have a question.
Yes.
Am I reading your memo correctly, Robert, that it says the fee increase would run through the end of our current term and any renewal periods after that? You mentioned just a little bit earlier it'd be up for negotiation. I get that it's always negotiable after that fact, but the way I read this literally says that it would be assumed that that fee increase would be included in any extension.
That is correct. So that is true, but you know, the main reason why the main argument State Street is making is basically that inflation is so high for them that, you know, it's causing them to rethink their fee structure midterm. And so if indeed inflation kind of settles down and rolls over, which it sort of looks like it has it at this point, come November, at the end of the term, we can basically renegotiate with them in any way that the board sees fit. So yes, the current amendment would say that, but that doesn't necessarily mean that we can't change that come November.
Robert, if I could please follow up on that. So are you saying that if the board votes to do the 5% increase, that's going to carry on past the current contract period? And so maybe there'll be a long-term benefit because maybe they would have raised it more after November 30th? Or is this just something that's going to be a 5% increase up into the contract and then we have to renegotiate?
This would be a 5% increase up until the end of the contract in November. When that new contract comes up, we at that point could negotiate and say, hey, look, inflation's calmed down. You know, there may be other changes in the fee structure at that point. You know, I'm not entirely sure the impact the next, you know, 10 months are going to have on State Street's thinking with the fee structure. So we're not locking ourselves in necessarily. The end of the term is November. At that point, we can say, hey, we're not agreeing to this anymore. We think things have calmed down. There may be other changes to their fee structure, you know. It's hard to say. I don't know what other changes they may propose.
Trustee Harris.
I'd like to move that we approve the fee schedule contract amendment for November to the end of our contract and then renegotiate.
Second.
Okay, it's been moved and seconded to adopt this fee increase or approve this fee increase. For any other comments or questions?
What they do is minimal.
Trustee Cubson.
I'm just curious why we wouldn't agree to the fixed fee that we'd had before. And I just also want to point out that I don't know that we would do an extension, but this tends to imply that if we did an extension, it would automatically be included with the extension. And I don't know if that would make it more difficult to negotiate an extension if for some reason we went with an extension rather than an entirely new contract. So I just want to, you know, point that out for discussion. I mean, it seems good right now as long as, you know, but if the market recovers, then we're paying, you know, more than we were paying before. So I just want to make sure we point that out. I mean, I don't really have a strong feeling either way, but it seems like if we were paying a fixed fee before, I just wonder if we would want to consider requesting more fixed fee now and being willing to negotiate in the future. Just a thought.
Doris?
Just to ask for a clarification of Ms. Cubison's comment, would you rather see perhaps an account maintenance fee at a set dollar amount as opposed to 5% increase of total fees, which is then tied to assets under management, something like that? Because we certainly could try negotiating with them or just returning to or just continuing the fee structure that is currently in place. It is, you know, a request from them that won't go into effect unless it's agreed to by both parties. I don't know if Robert had any conversations with them regarding any of the other fees. I don't believe we discussed that, but I wanted to know if that was more the direction you were looking at. Sure, Shamise?
I just wanted to bring it up for discussion. That was all. I mean, you know, right now it's really difficult to predict. I know, obviously, you know, retaining employees and in key positions is a challenge in virtually any industry right now. I guess I just would be concerned if we are locking ourselves into something in the future that might end up costing us considerably more than we had initially intended. But, you know, there's no crystal ball on exactly, you know, what the market's going to do and how quickly we might be impacted by that. So, you know, 1 year is probably not, you know, significant in the time frame that we're looking at. I just want to be sure. I haven't sat on the board long enough to know whether we would be considering an extension, an automatic extension of some kind, or whether we would really truly be in the position to negotiate when that renewal comes up, or if this fee would kind of essentially be already automatically included.
We do have a motion on the table that's been seconded. Trustee Harris has a comment about her motion.
In particular, my reason for making this motion is the last part of the middle paragraph, and that is to maintain the resiliency, strengthen and maintain the resiliency of their cybersecurity programs. And at this point in time, I think that is extremely important.
And I agree with Shamise. If we are making this agreement for this year, then I don't have any problem with it. But if it's locking this into something in the future that we're not prepared for, then we should reconsider. But it sounds, Robert, like everything's renegotiable in November.
Yeah, I think that's right. 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 I think that's right
That's correct.
Okay, there is a motion and a second on the table to approve this fee increase. If there are no further comments, we'll do a roll call vote.
There is no public in attendance.
Thank you.
Ms. Cubison,
Yes.
Mr. Hawkins,
Aye.
Mr. Jurdy,
Yes.
Ms. Smith,
Aye.
Mr. Cromer,
Aye.
Mr. Shoemaker,
Aye.
Ms. Harris,
Aye.
approved.
Thank you all. I have 10:12 on my watch, and the next item is the audit committee. And then we've got the CAFR that's not a CAFR anymore. So everybody ready to take a 5-minute break, 7-minute break? Something, or do you want to just plow? I'd like a 5-minute break. How about it's actually 7.5 minutes? We'll come back at 10:20. Okay? Thank you all.
Are we tuned out? I get more of this here from Monday night to
Meeting back to order, and we will move on to agenda item number 6, which is the Audit Committee report and recommendation. So I'm not even sure who was the chair of the Audit Committee this year. Jim. Jim was chair of the Audit Committee. You have a report for us, Jim.
I'll give you a brief report, just introduction, and if Doris or Robert would like to follow up, that'd be great. We did meet with Brown Armstrong. They just had an unqualified opinion on the financials. They went even further than we had done before as far as validating some of the corrections that have occurred in the error correction program at our request. And they overall, looking at the internal controls, they seemed quite happy with not only what we had in place, but the direction we were going. I think every year there's some concern about the size of MCERA. It makes certain internal controls a little more difficult than others, but they were pleased with the direction that staff has moved on historical comments. So overall.
Doris or Robert, have anything to add?
No, I think the audit went off very smoothly, and we had no issues that came up during the audit process. The committee seemed happy with the additional testing that they had asked for regarding the historical benefit review project, and I would say we're good to accept the audit report.
So as a former CPA and auditor myself, I've read lots and lots of audit reports, and I do appreciate the thoroughness of this one. The management discussion and analysis and the footnotes always tell a lot of information about the organization. So any of you who want to know more about MCERA can read through those notes. There's a lot of good stuff in there. I would entertain a motion to accept the audit as presented.
Move to approve.
Chair, the audit committee recommendation constitutes as a motion and the second motion. So we
Okay.
just need a roll call vote.
All right. Sorry, Dan, don't get your name in the minutes for moving that. So we will do a roll call vote on adopting the audit committee report.
Ms. Covison,
Yes.
Mr. Hawkins,
Aye.
Mr. Jurdy,
Yes.
Ms. Smith,
Aye.
Mr. Cromer,
Aye.
Mr. Shoemaker,
Aye.
Ms. Harris.
Aye.
Approved.
Thank you all. We'll move on to item number 7, discussion of possible action regarding the annual comprehensive financial report and the new popular annual financial report. And I didn't ask for public comment on the audit committee report. I forgot to. How about public comment on item number 7?
There is no public in attendance.
All righty then. So Robert or Doris, or whoever's talking to us about the.
Thank you.
AFCR.
Thank you, Chair Smith.
AFCR, I'm sorry. AFCR.
The AFCR. Yes, we went ahead and presented the full AFCR to the board this year. In past years, it hasn't been presented to the board. We did that because we also wanted to show you this year the new PAFR, the popular annual financial report. It's a simplified report. We drafted it. It will be distributed to all of our membership via our normal channels as far as email distribution, via the newsletter, and posted on our website. The popular annual financial report is just a summary of highlights from the full AFCR, and we will be submitting it to GFOA for consideration for their achievement award.
And Sarah has received the achievement award for several years, right?
But we've received the GFOA award on our AFCR, and they have a separate award that they provide for a PAFR. The PAFR, I think, makes a very nice, easy, high-level summary to provide to people. If they want more detail, they can certainly go to the full 100, page AFCR. And it's attached for you to look at. If you have any comments, we'd be happy to hear any feedback from the board on that.
I like the PAFR. I thought it was a good job. It puts a lot of information in just a few pages, so it was good. So maybe you'll get an achievement award on both the AFCR and the PAFR.
I expect so. This was essentially just an informational item. It does not require any action.
Okay. Thank you then. So we do have an action item in agenda item number 8. Discussion on possible action regarding compensation earnable and pensionable compensation resolutions. There are 2 resolutions. I believe we can take them together. One has to do with non-PEPRA and one has to do with PEPRA. So Doris, do you want to summarize what the changes are?
Yes, thank you. There's 3 pay codes included in today's memo. One of them the board had previously considered. It was the Superior Court code, which they previously had referred to as a travel stipend. After they implemented it, they said, well, gee, we thought we were mirroring this code from the county that's pensionable. What's the difference? I explained that they had a criteria of where the person's residence is in order to qualify for the pay that made it not applicable to all similarly situated persons in that greater class. And that's why when this went to the board as far as pay code 335, the initial determination or recommendation had been that it would be non-pensionable. The court has gone back and removed that requirement as far as where the member resides. It is now available to all eligible court reporters, and that makes it a true assignment pay, which is pensionable, and that this memo reflects the change to include pay as a pensionable pay item. There are 2 other additional pay codes from the County of Mendocino for the MC lemma, the not legal, but Law Enforcement Management Association. And these were a longevity pay code and another assignment pay code. We'll have a couple more pay codes coming back next month because the county has been ratifying new MOUs with all the bargaining units. That's why you're seeing a flurry of activity these last several months with new pay codes being created.
Okay, comments or questions from any of the trustees? And I would entertain a motion to adopt these new pay codes.
Madam Chair, I'll propose that we adopt resolutions 2022-30 and 2022-31 as presented.
Second.
Okay. Been moved and seconded to adopt the resolutions defining compensation earnable. So any further comments? Let's take a roll call vote.
Ms. Covison?
Yes.
Mr. Hawkins?
Aye.
Mr. Jurdy?
Yes.
Ms. Smith?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Approved.
Thank you. All right, agenda item number 9 is discussion regarding the administrative report. So I'll turn it over to Executive Director Rich.
Thank you, Chair Smith. At the beginning of the report, there's just a couple of reminders regarding some upcoming due dates. The board performance evaluation questions that were sent out for feedback from board members. The due date for your responses on that is December 30. Waiver of recourse premium for the fiduciary insurance coverage is due by January 18th. And then there's an upcoming filing notice for the Form 700 under the FFPAC. I have a couple of pension gold updates. We have an issue with the journal entries for reserve transfers and an issue with final average salary. I'm working with pension gold on getting those items corrected. I also have comments on some upcoming staff projects that they're working on, and attached to the report are both the SACR's legislative update and the RV Coons report. If you have any questions on any of the items, I'd be happy to answer any questions.
Well, I would like to urge my fellow trustees to turn in the things that Doris is reminding us of. I've been in Doris's position before, and having a board that you have to remind all the time gets repetitive, I guess. So she is looking for questions for the evaluations for trustees for the board itself, and I would appreciate you doing that. Otherwise, you will be stuck with whatever questions the 2 or 3 of us that have done the job decided we wanted. So please look at that and turn in your $9 as well. And I wanted to comment too, Doris, on I really appreciate the information you've been providing us on the work that you've done with Pension Gold and the staff projects. I mean, it's just informative for us as trustees to know some of the work that's going on here. And it was interesting to me to see that first item you mentioned on Pension Gold, you know, that had been 7 years ago. We've been making errors for 7 years. And I just appreciate your insistence on getting into the details of it and helping us all to understand what needs to be done and how it needs to be corrected. So just thank you for your work on that. Appreciate it. Any further comments or questions on the administrative report? Okay, let's move on then to general board member discussion. Any reports or comments from board members? I could report that the ad hoc committee on the executive director performance evaluation has met several times, and we're getting to a place where we may have a draft form. And Doris and Judy have graciously agreed to take that form and make it look like a form rather than the 3 of our scratches. Actually, it is in pretty good shape, but how to format it and everything is not our forte. So we're about ready to send that on, and we just will plan to have something ready for the board to go through the process that will be necessary starting in the spring for the executive director evaluation. Any further committees or conferences or anything anybody wants to report on? Okie dokie. Then we are going to move into closed session. We do have 2 items, disability applications in closed session. I'll check one more time if there's any public comments out there on any item.
There's no public comment at this time.
Okay. All right. Then give us a few minutes for us to move into closed session, and we'll come back for our disability discussions. session now, and we've had 2 closed session items, and we will have our attorney Jeff Burke report out.
Thank you. On item 11A, the service-connected disability retirement application of Margaret Harold, the board voted unanimously to grant that application. And on 11B, the service-connected disability retirement application of Margaret Luna, the board voted unanimously to grant that application.
Thank you. And thanks to the board, we are ready for our adjournment. Thank you all, and Merry Christmas and Happy Holidays. And we do have our next board meeting will be Wednesday, January 18th, 2023 at 8:30. And it will again be both in this room and by Zoom. So the meeting is now adjourned, and thanks to all of you.
Take care.
See you
Bye,
next
all.
year.
Happy holiday.
Happy holidays.
Happy holidays.
Great, please.